so much for being here today. So what I'm going to go over here today are the kind of 7 different income strategies, and going to show you how they work, and then show you the differences between them based on the risk to reward. So, what you put up, what you risk, and your potential return on that capital at risk. So it'll give you a really good sense of how these things work, and maybe the best strategies that you might want to incorporate into your trading portfolio down the road. So again, thank you for being here. I love these Saturday events because markets are closed, so we can kind of focus in on, whatever we're talking about options today and option selling strategies, and then we can, take questions, kind of interact. So a lot of good stuff. So little background on myself. I started my trading journey back in the 80s on the oil side. I was fortunate enough to get in with an oil company called Coastal Corporation. They actually had a training program where they would train you how to trade crude oil. So it was pretty fascinating, pretty amazing stuff. And spent about 5 years with them. Went out to their office in Singapore, worked out there a couple of years trading products and Asian crudes, and then came back to the US and was hired by a company called Transworld Oil, which at the time was the largest oil trading company in the world. It was Transworld, Fibro, and Mark Rich, three of the biggest. And spent 17 years there. And that's really where we got the lights really turned on, because we were pretty much involved in all the different trading markets, from the energy side, pretty much everything there. And then we got into foreign exchange and futures and all kinds of commodities and stuff like that. So ran the trading desk, spent about 17 years there with Transworld in Bermuda, and then ran the trading desk there, international trading desk, for 10 years. And that's where I first started trading options back in about 1987. So it's been my journey and my path ever since, and I love options, and that's what we're going to focus on here today. So let us get started. So the following presentation is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. So, option income selling type strategies are unique because they enable you to enhance your returns by way of combining long options and short options so that you can generate income on a regular basis. Now, these types of strategies are typically short duration, whereby the option premium is sold either on a weekly or monthly kind of basis. So this can really generate significant percentage returns on your underlying security, even if it hasn't moved. So it's like collecting rent on a security or a rental property that you have, but this is like collecting rent on your security. So it's a great way to kind of compound and increase that returns on something that you may already own. Now, step one is to understand how the options pricing works, and it really comes down to knowing how to sell time and how that how you take advantage of that component of an option price. So when trading options and strategies designed for income, the most important option factor to understand is the concept of this time and its impact on the price of your option. So we can actually trade time by selling time to take advantage of that option time decay or the time value of your option. So the time value, which we refer to as extrinsic value of the option, it's the premium a trader or the investor is willing to pay over the current exercise value based on that option's potential to increase in value before expiring. So it's this change in the value of your option based on this time decay. We can actually measure that using the Greek called theta. And this time decay increases as expiration draws near. So it really starts to accelerate and will actually decrease as your options go more in the money or out of the money. But it's a decaying part of your asset or your security value. So we can take advantage of that with different option strategies. So this decay accelerates and really starts to get, really soars in the last 30 days. That's kind of the sweet spot when you're selling options in the last 30 days, where it really starts to decay on you and eventually will go to zero. So here's a chart to kind of illustrate how this time decay can really start to increase. So when you go out, let's say you start out 120, 90 days out and you're a buyer of options, you're going to have very little theta decay. So you're getting the gift. If you're a buyer of options, you want to be far out in time because you're not going to get impacted as much. But as we start getting in closer to that day zero where it expires, then you can see it starts to really slide off. And when we get 30 days from expiration, that's where it really accelerates. And we can take advantage of those weekly options that we currently are trading in the markets to really play this accelerated theta decay. So it starts out slow and then decays, and at the end of the contract date, it basically is worthless, just like a coupon that you might get at a store. You know, you use it, and then after the redemption date is gone, it's no longer valid. Now, step two is you want to know how the option pricing works in general. So we'll go through kind of what makes up an option price. So it really comes down to, again, this component of time, so your time value, times the implied volatility of your option, times the underlying security value, or that intrinsic value. So once you know these variables, then you're going to be ready to price that option out and know what option premium should be, and then select what option strategy to use. So here's a kind of example of how this kind of flows through. So, you know, if you're using weekly options, is pretty much what we kind of consistently use. Every Thursday, we get a new option series. And so that first day, we have 100% time in that option price. So time value times the implied volatility times the underlying security value, that intrinsic value, which we'll keep constant to illustrate this, that gives you the price of your option, your premium. So that first day, you've got 100% time. I put an implied volatility. I just kind of threw a number in here of 300, so you can see the price is 300. Now you come back after the weekend. So let's say we come back in Monday, the time component of that option is cut in half. So it's halfway done, right? So even if the implied volatility has been spiked up in this example to 800, it, you know, barely moved the price up. So it's, you know, 400 right here. Now let's say the implied volatility was only 200. Okay, so you can see that within your value of your option would be worth only $100. So the big takeaway is that at the end of the day, at the end of this life of this option cycle or series, time goes to zero, and also implied volatility goes to zero. So when we're selling options, we're actually selling time and we're selling volatility, these two components. So we can take advantage of that, those two components going to zero at expiration and keep that premium that we bring in. And we can pocket that, you know, as far as part of our profit or revenue generation. And what I like to do is combine these types of option selling strategies with buying strategies to get the benefit of both the better leverage from buying and then the extra premium and positive theta that you get from selling options. So we're going to go through a bunch of different strategies to show you how they work and how this, you know, all kind of flows through. Now, the next thing you need to really understand in trading, especially options, is probability. So it's what the market makers, what I call the market maker secrets, kind of what they don't want you to know in order to take advantage of you. So those professional option traders are typically on the sell side to take advantage of these probabilities. So when we look at the option markets, we use mathematical market probability statistics for pricing out the movement of an option to its expiration. So by knowing the probability of your underlying security finishing within a certain price range at expiration, this becomes key to determining then what options you want to look to buy or sell, and then what option strategy to use. So this forecast that we're going to look at is what we refer to as the implied expected move, or the implied move of your stock or your security. And this implied move is estimated by what we call a standard deviation. So plus or minus one standard deviation move of your underlying security to its expiration. So we can use this to forecast where price targets can be either up or down using this theoretical, you know, forecast. But it's a great way to start to give yourself, you know, idea of the probabilities of your trade working out. So if we're selling an out of the money option, one standard deviation out of the money, you're going to start out with an 84% probability theoretically of that being a winning trade. So the way this works is when we look at an option, it basically has what we call a delta, and the full value of the delta is 100. So kind of equate that as to 100 shares of stock. So remember, one option contract is equivalent to 100 shares. So from this, we derive the delta. So if you have a delta of positive 100, which would be like your equivalent to you buying 100 shares, that would be one option contract. We look at the deltas. And so if we have a delta of, let's say, 16, That's if right here, so this 520 level, that would be like a 16 delta. And so if we have a delta of 16, then you take that from your 100, that gives you the difference is 84. So we say that's the probability of that trade. So theoretically, the probability is that if you are selling a short strike here with that 16 delta right there in this example, 520, then going into this trade, theoretically, the probability of it closing at 520 or below is 84%. Or the other way to look at it is you have a 16% probability or chance that price could get to 520. So that's a really big thing to take advantage of from selling options. So if we look to here in this expected move, this is the option. It's pricing at the money at $500. And let's say we've got an expected move of 4% up or down. So 4% up on this one would be 520. So that's your expected move up, and 4% down is 480. That's your expected implied move down. So the range between the two is your one standard deviation. So that's how we can take advantage of selling options for this kind of theoretical probability. So let's go on and we'll look at some different strategies that combine selling and also buying options to show you how they can really benefit you based on the different strategies we look at. So that's a really key thing to understand, are probabilities. Okay, so that's kind of the basis or the basics of how it works. So if we look at the delta, here's another example of an option chain. So here's Apple. All right, so Apple here is trading at $190. In this example, this is a 5 July contract series, so it's got 28 days to expiration. So if we look at the different delta and what that is equivalent to as far as probability, we'll start out here with the at the money strike 190. And you can see here it says a delta of 52. So basically way you could interpret that is that you've got a 50-50, basically a 50% chance that price will either be at 190 or below or 190 or above. Now, when you go further out of the money, let's say you go to the 215 strike, you look over here at the delta and it shows you 0.05. And then right here, this is probability out of the money. So that equates to, okay, if you look at 0.05 and you take your 100 delta and you subtract 5, then you've got a 95% probability that that will be at 215 or below at expiration. Or you can look at it as you've got only a 5% chance or 5% probability that'll be at 215 by expiration in the next 28 days. So that's a quick way to use delta to understand the probabilities of different strikes that you're looking at to potentially trade. Somebody said that slides are not changing. Are these slides changed for you now? Should be changing, okay. So here's the next one. Does that look okay? Must have been an issue on his side. So, come back in, log out and come back in, it should be working. All right, thanks. So now when we're using these kind of probability analysis, what it is going to give you is a very useful tool that you can use to determine price targets. So these price targets to trade against. And on most platforms, this is a free way to, to go and use this tool. So based on this math of probability, you can see that approximately 70% of options that are bought will expire worthless. And based on this, it's a really good idea for traders and investors to consider not only selling options, but just buying as well. So we're going to look at selling and buying options. And then what I'll show you are different strategies that combine these two components together, show you how they work, show you the risk reward, and then you can maybe have a better idea which ones you might like to use for your trading. So, by adding these kind of income selling strategies to your trading portfolio, it's really going to make a really dramatic and positive difference to your trading performance over time. And remember, trading is a business of probabilities. And so to be successful, it's really going to come down to controlling that risk that you have by incorporating these types of high probability option strategies. And we'll go over a bunch of them here today so you can see how they work. So let's get to the different strategies we'll look at. So in my opinion, like one major goal for you as a trader is to select these types of trading strategies based on what's going to give you the most consistent positive return with low defined risk and not always that greatest return. So I always talk about, hitting singles and doubles in your trading, and occasionally you're going to hit that home run. But if you go into your trading looking to control your risk first and then you look at your return, you're going to be more consistent and have a better equity curve. So, let's take a look at these different strategies and I'll show you how they work. So the best way to achieve this goal is to know and understand how the different strategies work and then pick and select the one that's best suited for your trading style and your time to trade, your capital at risk. So, everybody here has a different amount of capital. Peter may be trading with $1 million account and Barbara might have, 100,000 or 10,000. So it'll really make a difference as to how you want to trade. So we'll go through these strategies and then you can get a better sense. So the ones we're going to cover here today are what I call some of the top income selling strategies. So not only do they sell though, but they're going to also have a buy side component as well, typically. So what we're going to look at, we're going to cover and go through what's called the cover call, a protective collar, which is kind of a hedged cover call. We're going to look at the vertical credit spreads, iron condor, butterfly, and then we're going to really dive into the income calendar and the counter diagonal. So you're going to get a better sense of, what makes these work and then kind of have a better idea of which ones might fit your trading style that you're looking for. And so what we're going to do, I'll compare the risk reward, which will really make it clear to you, how these can perform for you in your trading portfolio or even investing portfolio. So the first one we're going to talk about is the covered call. Now this income strategy is kind of more like a longer term strategy, which can be used, by traders or investors, but a lot of the institutions will use this for their clients. And this is what we call the covered call. So it's kind of the most basic income strategy, yet it's highly effective for bringing in either weekly or monthly income. Now, here's an example. So, Joe goes out and he buys, say, 500 shares of the company XYZ. And he bought those shares at 40 bucks. Now, he's tired of just getting his annual dividend return of about 2.5%. So he's heard that you can actually earn income from your stock if you sell call options against it. So here's what Joe does to do that, to collect some more income. So let's say on the March 6th, Joe he sells 5 April monthly call options with a strike price of $42.50 at $1 each. So he's getting $100 per contract that he sold. Now that would be $500 that's put straight into his brokerage account for selling that strike. So remember, he owns the stock at 40, but he sold the strikes out of the money at $42.50, and he got $1 for each option that he sold. So he's brought in $500. Now, at the end of that 6-week period, if the price is not at $42.50 or higher, Joe gets to keep that $500, and that's like a 2.5% return in 6 weeks. So that's, really great. He's really thrilled with that. So it's better than just that 2.5% annual dividend yield. He's getting that, plus now he's getting that additional 2.5%. So this could be a really good strategy if you've got different stocks you've owned for a long time, IRAs or things like that, to do covered calls. But now remember that these are also, they can be highly risky. So the reason is that, let's say you own a stock and you pay, $10,000 for that stock. Now, if you've owned it for a long time and you want to keep that stock, it's a great way to collect additional rent on those shares that maybe you own and they cost you $10,000. So you just keep selling against it and receiving that income. But if you're doing this to speculate on the markets going up and down, what can happen is let's say you bought a stock for $100, to do a covered call, and then all of a sudden the market collapses on you and goes down. Now that stock that you bought for $100, well, you sold some calls against it and made some income, but now let's say that stock is worth only 50 bucks. So that's the big negative with the covered calls, unless you have this in a portfolio that you don't want to sell the stock off for tax reasons and you just want to collect income. So I want to point that out. So it is a good strategy for certain situations, but not one just to kind of consider just for speculation. So now let's go to the next step. So here's what it means. Joe is then giving the right to the buyer of that call option to buy that stock on the third Friday of the month or before. So these are typically American options. So he's given that right to that option buyer so that he could buy, if he wanted to, that stock with the strike price of 42.50. Now he could exercise that any time he wanted, actually. Now here's what happens on that Friday of expiration. So now let's say the stock that he bought at 40, he wrote those calls at 42.50. Now the stock's only worth, it's only trading at 42. Well, it's gone up, but it didn't meet his strike price at expiration. So it's going to expire without exercising, and Joe got to keep and pocket that $500. So he keeps the stock, plus he made $500. So he is liking that a lot. That's a great strategy for Joe with that stock that he wants to maintain. So now what happens though if the stock did go to 43? Well, the thing you can do is you've got the options. You can buy back those options that you sold. So before that day of expiration or the day before it expires on that day, Joe could have just bought the options back. Let's say that had gone down though, he sold them at 100, and based on that time decay or component that we talked about earlier, they went down in value because of that. Now they're only worth 50 cents or $50. So he could just buy them back for 50 cents, and he made that 50 cents on that options he sold. So he had originally sold at $1, buys them back for 50, he makes 50 cents or $50. So this would be like a 1.25% return over that 6 weeks, or on an annualized basis 10.8%. So it sure is better than that 2.5%. So it's a great strategy for stocks that you might own in a portfolio that you want to keep and collect additional income. Now, as long as Joe owns those shares, he can just keep selling these options for the next month or week on a weekly basis and repeat the strategy over and over. So, there are other adjustments, but this is the main kind of goal or concept of covered calls, is to collect that income or rent on a weekly or monthly basis on these long stock shares. Now the next strategy, I call it 1B, because this is using the covered call, but it's adding what we call the protective put or protective collar. So this is a really great way to do it, especially in this market environment where you're worried about the downside plunge that could happen anytime. So to build on the covered call example, here's how it works. Now, when a stock with a covered call drops in value and you own a put against it to protect your gains against any downside move in the stock, this is what is known as a protective collar option strategy. So basically what it's doing is combining two different strategies together. It's combining a protective put with a covered call. Now, a protective put is sometimes also, we call it the Mary put. So what this does, it involves being long a put option and long a stock, okay? And then the other strategy, the covered call, involves being long a stock and short a call. So when you match these two together, then you have what we call the protective collar. So if you're doing covered calls, you might want to look at adding this collar to your covered calls to protect your downside. So if the stock goes down in value, the call options that you sold against it are going to go down, and that would allow you then to buy back those call options at a cheaper price if you want, and that's going to give you a profit on those calls that you sold. So that's the covered call side of it. Now, most likely these call options are going to typically expire worthless, if they don't get your short strike. So remember, you sold the call option at the higher price in this case. So for example, let's just say you own the shares at $100 right here, and you sold that call option up here at 105. Okay, so you short that call at 105 against it. Now, if you owned a put against it, so let's say you bought a put down here below it at 95, okay, so that's going to be protecting your downside. So the value of your put that you own would also go up in value. So if you're long a put, and the value of your underlying security that you bought that put against, buying a put is typically you're going short. So that if the put goes down, if the value goes down, that your security goes down, and you have those long puts, your put value goes up. So the value of your underlying stock goes down. So what you have here, so if the stock goes down, you lose value on the stock, but your short call is going down in value. So you can collect that premium that you sold, keep that. The put that you're long, if stock goes down, that goes up in value as well. So these two offset the value of your underlying security. So it's a really great way to protect that and also lock in, upside or downside protection. So let's take a look at, how this would work on, Joe and his 500 shares. So Joe, he bought those 500 shares at $40. And on the 9th of March, the stock was trading around 45. So he had a nice gain to the upside of about $5, but he wants to temporarily kind of hedge this position due to all the increased overall uncertainty of the market and the volatility. So what Joe does, he goes ahead and he buys 5 April monthly put options on XYZ. And remember, one option contract is equivalent to 100 shares, and he's got 500 shares. And so he bought those puts with a strike price of $39. Now that cost him 90 cents per option contract. But at the same time, he also sells 5 April monthly calls on XYZ at the strike price of 49. Okay, and so he received there $1.10. So now he owns the shares at 40. The shares are now trading at 45. So he wants to protect that upside value gain. So he sells a 49 strike out of the money above that, and he buys below the 39 puts. So now he's got a collar. So let's take a look at what this does for him and the kind of that cost of it. So by implementing this collar strategy, he's got 500 shares at $40. He bought the 39 puts and he paid 90 cents per contract. He sold the 49 call against it, brought in $1.10. So the cost of his collar, actually in this case, he's brought in a credit of 20 cents per share or contract for doing this collar. So if you look at it now, his break even went from a 40, his stock price. What are the deltas? So typically what you're going to probably be looking at, so this would be the shares right here. And if you typically you want to sell like a 20 delta, okay? So I would like, on covered calls, look out to sell like a 20 delta or something like that. So that going into it, that gives you a 80% probability theoretically that, the price will be below that short strike. Because if you own the shares, you don't want to get exercised or you don't want to lose those shares, right? So if you sell about a 25 delta, that goes into that giving you pretty good security. Now with the put side of it, typically you may want to do the same. You may want to buy, depends on where the support resistance is, but typically it might be like a 30 delta or something like that, or maybe a 25 or 30 delta. So it just varies. It depends. You just have to look at each one differently, because what you're trying to do is, let's say you own those shares here at $100, okay, and you want to keep them, right? So, but you're worried about the downside risk. So you sell those calls up here, well, let's just go to Joe's example. Let me just erase this and give you better examples, kind of to kind of keep it constant with this one. So you've got the $40 a share here, and it's trading at 45. Okay. So Joe, though, he wants to keep the shares, but he's able to sell the 49 calls here. So this would probably, I'm just going to throw out a number, probably be a 20 delta. Okay. Now he's going to sell that. That's going to bring in premium. So in this case, he's bringing in a premium of $110. Okay. Now he's going to buy below here, puts down below. He's going to buy the 39 puts. So those are going to maybe cost, let's say those costing, let's say he pays, well, here it is. He's going to pay For those puts, he's paying $90 or 90 cents. Okay, so he can finance those by selling the calls, right? So that's basically what he did. Now this depends on where you want to protect it. So let's say he owns the shares here at 40, and there's really good support down here at, let's say there's really big, huge support at 39. So, and then if it breaks below 39, there's a lot of downside potential exposure. So that's what you got to look at. You look at your charts and kind of map out where you think you want to hedge that position. And then typically with this type of strategy, you want to try to recoup your put cost by the calls that you sell. So in this example, you get a net credit. Sometimes it might cost you a little bit. It just really kind of varies of what kind of protection you want to construct against those shares that you own. So each one is going to be a little different, but that's kind of general, kind of the rule: 25, 20, 20, 25 delta on the upside, and the puts maybe, something similar, maybe further out, but it depends on, what you're trying to protect. So going back through this example here, then you can see his break even has gone from those $40. Now he's got a credit of 20 cents a share. So his break even now is $39.80. Now his max profit is capped at 49. So if it gets to 49, that's the max he can go. So that's the negative. But he's happy with capping it and protecting his downside. So on those 5 contracts, and you just got to go through the math. He's got 5 contracts times 100 to make it equivalent to an option contract. And he had the calls that he sold at 49. He received that credit of 20 cents or 20 cents here, right here. So less the cost of his shares. So his break even then is $4,600. Okay, so that's not 4,000. That's his potential profit. So he would make, if it goes to 49, his max, he's capped out, but he makes $4,600 on those 5 contracts. That's a 23% return. So he's really happy with that, so 4,600. So 4,600 divided by 5, that's, $920, per contract. Make sure that's right. Hold on. Yeah, so he's making 920 is his dollars per contract, on this covered call that he sold up here at 49. Now his downside exposure is max loss on the stock. If it's at 39 or below, he's capped it at 39. So he's got those 5 contracts times 100 times the underlying security less the cost of his put here, 39 plus the 20 cents credit. So his exposure on the downside on those 5 contracts is $400, or he would lose 2%. So he's happy with this. He can make a 23% return, but his exposure on the downside, he's capping it at a 2% loss. So much better than if he just did the covered call with no downside protection, and he could potentially lose 50% or even the whole thing. So this is if you've got stocks that you own in your portfolio, you might want to start, adding a protective, put to it to create this kind of collar strategy. So, you can see then by adding another leg or two to your trading strategy as that layer of protection. And in this kind of market, it's a really wise move to make. So what you don't lose is a lot of times is, as important as what you make. And so in this market, you want to really protect your exposure to the downside and protect it, and risk management is key to staying in the game. Now, the next one we'll look at is a very popular way to collect premium without, having to own the underlying like a covered call. And this is just what we call a vertical credit spread. So when we look at this, there are 3 basic types of credit spreads. So you've got what we call the bear call credit spread. We've got a bull put credit spread. And then we've got, when you combine those 2 together, it's what we call the long iron condor. So you're in these 2 types of spreads, you're selling time, and you're basically selling volatility, and you're receiving a credit or premium. Okay, so that's what a covered call, that's what these credit spreads are. So the bear call credit spread is going to be one that you're going to want to use if you think the market's going to probably go down, but it doesn't have to. It could go sideways. It could get kind of hover back and forth, just goes sideways. But since you've sold time and volatility, which go to zero, you're going to make money over time, even if the stock was to stay stagnant. So what you're doing is you're selling one call, so in the same series or option series, while at the same time buying one call with a higher strike that's going to cap any upside, potential if it goes straight up. So you've capped your risk. So that's a covered call. So typically, these are what we call a negative risk reward type trade setup. And what that means, let's go through this example. So let's say here you sold short this strike right here. Okay, you can see right there the 1020. So you went short this 1020 strike, and let's say that had a 20 delta. All right, so to equate this back to probability, okay, remember, one option contract's 100 shares. So say we have 100, a delta of 100, and you sold the short strike here that had the 20 delta. So you're starting out theoretically this trade with the 80% probability that this will be a winning trade that will stay and close below that 1,020 at expiration. Now to cap this, if you did this naked, you've got unlimited upside risk. So to cap that risk, then you're buying the option contract above it at a certain strike. So in here, you sold that call there at 1020, but to cap that upside in case it goes up, you're buying that call at 1030 right here. All right, so you've got this credit spread, which is $10 wide. And you see the spread width is $10, which would be $1,000 based on an option contract basis. Now, this is a credit. The credit you received here is 200. So that is your max profit. Now, but the risk reward, though, look at this, your difference between the credit you received, which would be your profit, the difference is 800. So you're risking $800 to make 200. And so the return on this would be 25% if it closes below 1020. So, most people, if you don't understand the delta and the concept, you're thinking, well, why would anybody do that? Risk 800 to make 200. Well, it's all based on this probability of 80% theoretical probability. So this is what we call negative risk to reward ratio. So you're risking $4 to make $1. So, if you think the market's going to kind of be stagnant, not going to go higher, but just kind of moving sideways, but you think more of a bias to the downside, it's a good strategy to use. So what I want to do here, I'm going to show you, I'm going to go through each of these different strategies we'll talk about, and we're going to go through and we'll compare, and you'll see the difference between each one in the risk reward. So the first one is the covered call. Not the covered call, we've already done that, but I'm going to show you a credit spread, okay? And we're going to use Apple to illustrate this. So let me back this up. So I'm going to put up a chart and kind of give you kind of a layout of what this would look like, so you can get a better feel for each of these strategies, okay? So here is Apple. And Apple, went out trading on Friday at $155. So let's say that you want to sell a credit spread on Apple, and you're going to do it with a one standard deviation, which is basically like a 16, I'll say a 20 delta, just to make it easy to relate to. So what you're going to do here is we're going to sell a credit spread. So we're going to look to sell like a 20 delta, and we're going to do that and then do a credit spread. So I'm going to pull up the option chain here for Apple. And I'm going to go to, typically, what we want to do is, I'll typically, just to make it easy to kind of visualize and conceptualize how it works, I typically, a lot of times, will go 20 days out, so 2 weeks out or something, okay? So this would be, for this example, the 6 April series. Now, if we look at the delta here, I'm trying to look at for about, about a 16, 17 delta is that one standard deviation point. So just looking at it, it won't be exact. So I selected the strike price here, the 162. And so it shows a 23 delta. See the delta here? And then probability out of the money. So you're starting this trade out with about a 79 probability that this will stay below 162.50 over the next 19 days. So we're going to set this up. We're going to sell that 162.5 strike. And you can see here, you're bringing in about 120 bucks. But to offset the potential, if it goes straight up, we're going to cap that by buying $5 above it, the 167.5. So we're buying that call there. So this creates a bear call credit spread. So let's take a look at it, and let's look at the risk reward of this trade and how it works. So if you did this trade right here, what you've got is, let me pull this up, you sold this spread here, the 162.5 call in the 6 April series, bought the 167 above it. So this is a bear call credit spread. So you can see your premium, you brought in $85, that's your profit. Your risk is the difference, which would be 415. Okay, so that's your potential risk on that trade. So if you look at it and you do the math, that would be a 20% return. So that's your max potential profit. So your credit of 85, that's your profit. The difference is your risk, which would be 415, and your potential return, if it closes below this 162.5, you keep that $85, you made 20% return. Okay, so, but that's a negative risk reward trade, but it's a probability trade because you started this out, you sold that was like a 23 delta, which is like giving you a probability of 77% going in. So that's a bear call credit spread. So that's the call credit spread. So the bias is to the downside. Now the opposite of that is a bull put credit spread. So we'll go through that next. So if you sold a bull put credit spread, and we do the same thing, we're going to go out here and we're going to sell. Then we're going to look for about a 20 delta or whatever. So I put that out here. That's about that 147 strike. You can see here it's 23 delta right here. So that's 147, 23 delta. So going into that, selling that downside bull put credit spread down here, selling the 147, and then you're buying the 142 below it in case it goes straight down. You're capping your downside risk. So 23 delta there. So you're starting that out again as a 77% probability, and then you're buying against it the 142 delta here. Okay. So you've got this short the 147, long the 142, bull put credit spread. So that's if you're thinking there's more of a potential bias to the upside. That's when you would do that trade. Okay, so let's take a look at what that would look like. So now you would have the bull put credit spread, and that would be, we were selling here as the example, the 147 put and buying below it the 142. So we've got this trade. So we've got here a credit of $70, and the risk then is 430. So with this potential trade, the return on this one would be, you've got a potential of $70 as your max credit here, and the risk is the difference of 415. So what you've got here is a potential to make, that's about 11%. Let me see here. Yeah. So this would be, about a 16% return. So your risk is 430. Okay. So if you kept that 70, your return on that is 16%. So, that's, again, a probability trade. Now, all these things will be different because, volatility is different on the put side and the call side, so it can make a big difference. So you can see here the call volatility is less or better. Actually, we're talking about skew. There are a lot of things that go into it, but that's basically how it works. So by doing the covered call, you go into that, or the credit spread, call credit spread, you make 20% on that example. If you did the bull put credit spread, you're making 16. Now, if you put the two together, though, you're increasing your return on capital, and this is what we call an iron condor, a long iron condor. So really a good profitable way to do it for if you think that the market's more range bound. So let's say that you think Apple is going to stay within this kind of range to the upside, where it's not going to, go much higher than, 160 or 162. It's going to stay up here. That's the upside range, and then you've got a downside, down around this area here. So, you could do a what we call the iron condor. So you're playing this range, this upside range here by selling the bear call credit spread, and then you're selling the bull put credit spread down here. And so we've got what we call the long iron condor playing that range. So let's take a look at what that is and how that works out for you based on risk reward. One second, let me pull that back up. Okay, so that's what we look at, a bear call credit spread, and then the next one we went through is a bull put credit spread, best use when you think the market's going to go up. So this is where you're selling that one put in the same series and buying another put below it with a lower strike. So this also has a negative risk ratio, and in this example, which we went through on the screen, but here's like an Apple example here. So you sold, in this one, Apple's trading, and right here, and you're selling the 149 put right here. So you're selling this put, and then you're buying below it the 144 put, $5 wide spread. So that's $500. And below it, you're buying that 144 put right here. So you're long that. So you've got a bull put credit spread. In this one, you bring in $105 credit. The difference is your risk, $395. So you would make 26% return as long as it closes at 149 or above. But you can see your risk ratio, it's negative. You're risking $3.76 to make $1. All right, so we just went through that with Apple, and then if you combine the two together, that's what we call a long iron condor. So this is a long iron condor credit spread. So what it is you're combining the bull put credit spread and a bear call credit spread to use. So if you feel that the stock is going to trade in a kind of very tight range between your two short strikes and stagnate in that area, this is a great strategy because you're collecting good premium. You're actually reducing your risk because you've got that additional premium from either the put or the call. And it takes advantage again of that time decay and volatility crush. And it's a good one you can leg in or out. So if we look and relate this to the ones that we just looked at, you can leg in and out. So let's say it goes up here, you sell your bear call credit spread here, and then it comes down, you sell your bull put credit spread, or you sell it all at the same time. So here's an example of that combination. So you started out, you've got the bear call credit spread, you brought this in, and you brought in $85 credit, and you've got that risk though of your 415. But you want to do this, you think the market's going to stay stagnant in this range, so you sell the bull put credit spread, you add that to it, and now we've got this long iron condor. So what we have created is we're short that call credit spread here, short a call, long a call, okay? So short that at the 162 right here, and then we shorted the put, so we have two credit spreads. And we did the bull put credit spread right here, so we're short the 147, 142. Now, by doing this, we bring in that additional premium. So now we've got 85 from the credit spread here, 85 credit there, okay? And then we've also got the 70 from the bull put credit spread here. So we've got these two credits together. Now, if it goes out between these two short strikes at expiration, we've just kept that additional premium of 70 plus 85. So we've got a total of $155 premium that we received. The difference is your spread width of $500. So the difference is 345, okay? So that's your risk. So you're making 155 credit, your risk is 345. So in this one, if it goes out between the short strikes, you've just made a 45% return. So, by doing the combination, it's a great way to kind of reduce that risk, but also increase return. And you're playing for just that theta decay and volatility, what we call volatility crush. So that's the difference there. So you can see the different risk reward ratios and how they work. So let's just keep going. I'm going to go through a couple others to show you other spreads that combine selling with buying. Okay, so now we're going to look at not only the sell side, but we're going to combine a buy side strategy, okay? So this will enhance the returns. So the next one we're going to look at will be a butterfly spread. All right, so the butterfly is constructed by, and it's a very low risk, high reward trade. So it's a combination of not just only a vertical credit spread, but you're adding a vertical debit spread to it. So it's going to be a limited profit, limited risk, but a very high reward because you're by doing the debit spread and then adding the credit spread, we're reducing the risk of the debit spread, but the debit spread is where you're going to get the bigger return. So you're going to get a much bigger positive return on a debit spread. But then when you add a credit spread, you're going to reduce the capital that you're putting up at risk on the debit spread, plus increase your positive theta. Okay, so here's how that works. So you basically have three striking prices that creates what we call the butterfly spread. So we can either use calls or puts, and you're basically short time and volatility, but the trade results in a net debit. So for example, if you were doing a long call butterfly, it's just a combination of a long call here, a short call here, and then you're selling another call and buying a call here. So you've got a call debit spread right there. So this would be like a call, your long call debit spread, but then you're reducing your risk. You can sell that same short strike here. So you've got a call credit spread there. All right, so this is a butterfly. Now, in this example, the max risk then is $100. So you have the debit spread, you know, and you sold the credit spread. But if you convert this to the butterfly and you've got a max risk of 100 and you've got the spread width up here, you can see $1.10, 1,010, and here's 1,020. So that's $10 wide or $1,000 wide. And if your max risk is 100, that's your maximum risk, the debit cost. The difference is your potential profit is 900. So that's a positive risk ratio. You can make 900% return. So you're risking $100 to make 900. So totally, you know, different structure. So positive risk ratio versus a negative risk ratio. So let's take the same example and show you how that works with Apple. So you can kind of see the flow through and how these things work. Now, let's say we think Apple's going to go up and, you know, we're directionally bullish on Apple and it's going to go up and we think it's going to go to this 160 strike. So that's based on the option delta and that's kind of a probability. We think that's the first next area for, you know, resistance. So we want to target that 160. So we can do that with a very low risk trade and do that using what we call the butterfly. So with this example here, and just think of the difference, look at the progression of your risk reward, how much different these different strategies get, okay? So with this one, we're gonna look to, basically you're combining a debit spread. So we're gonna buy the 24 March. We're gonna go out to, let me just back up here and show you the option series that I'm gonna work with. So with this one, typically, you know, we go out maybe 1 or 2 weeks. So let's say we wanted to do this next week coming up, the 24 series, 6 days out. So we want to do a butterfly and we're targeting, you know, $160. So if you look at the expected move range here, it says $5.77 and it's trade at 155. That's like that one standard deviation up. So I'm just kind of pick that number thinking, okay, this is a good target, 160. Let me get my drawing tools. 1 second here. One second. I messed this thing up. Let me get my colors right. Bear with me. Oh, there we go. All right, so we're going to target that 160. And if you look at this delta here, you can see it's 20 delta. So that's one standard deviation up. And we think it's going to get to 160. Okay, so we're happy targeting 160. So we could do a butterfly, and we're going to do that by doing a basically it's a combination of your debit spread. So we're going to buy the 155 strike, sell the 160, and then we're going to sell the 160 again and buy the 165. That creates a butterfly. And look at the difference here on your risk reward and potential profit. So we're going to go through that. And so that's basically this combination right here. So I already set this up in advance to show you. So this would be the butterfly. So if you just break it down quickly, you've got your long at 24 March series, the 155 call, you're long that, okay? And then you're short the 160, and then you shorted that again, and then you bought the 165. So here you've got the call, basically a debit spread, 160, 155, 160. Now you can leg in or leg out, or you do it all at once, and then you've got that 160 strike there, and then you bought to cap that upside risk 165. Okay, so you've got the butterfly here that cost $150. Okay, but your potential profit is the difference between that and the spread width. So in this trade, you've got the potential to make, you're basically risking, $150. But if it was to go out right at your short strikes at expiration, your max potential profit on this one would be $350. Okay, so you can see the huge difference between the two. So this one you're risking 150 as your risk. Now you've got the potential, the max potential risk, so you can compare the risk reward, is if you nailed it perfectly and it goes out there, you're gonna make on this one a total of $350, and your risk is 150. So this would be a 233% return, okay? So much better than just the credit spread or the iron condor. Now the other positive thing here is also what we call positive theta, but that's basically what it looks like. And then you can leg in, leg out. Now if it goes out any place in between there, you still make a decent profit. So let's say you didn't get right at your target of 165, and let's say at expiration it goes out, let's say it goes out, I'll put it right here too, let's say it's at $158 and it goes there at expiration. So I'll just put that in, boom. And this is for expiration on the 24th, next Friday. So let's say next Friday, the 24th or whatever, is trading right here at 158. You're going to be up in the morning, you're up 112. If it goes out at 158 at expiration on that Friday, you're up about 160. So really good positive risk ratio trade. So really great strategy to use. Okay, so that's the butterfly. So now let's keep going. So I'm just kind of going through kind of what I call progressions of risk reward. Butterfly question: should butterfly be short duration, or can you go out 2 months? Butterfly should be short duration, because if you go out, you can go out 2 months, but you're not going to. That's what we'd call a vacation trade. Basically, what I call a vacation trade, because you're not going to make any money if you go out real far. So let's say you go out, here's 2 months. Let's say you go out to the May 19th series and you do the same butterfly. It's basically dead money until you get to expiration. So let's say you did this 2 months out. So you did the 155, 165. Let's say we're doing, hold on. Let's say you did the 155, 165. Hold on, let me get this right. Yeah, 155, 160, 165. Okay, you can see how cheap it is, 55 bucks. But you're not going to make any money on this until you get to expiration. So you can see that flat, see how flat that is? So let's say you get to, let's say, next week on the 24th, it's trading right here at 160. You're short your butterfly, you're still, you're not making any money. You're not going to make money on this until you get to that expiration date, which is way out there in May. So that's basically, how that works. So it's better for butterflies 1 to 2 weeks out, short duration. Now, the next thing I'm going to go through are 2 other really great strategies. So I love the butterfly. but I also love these two that I'm going to talk about, and you'll see why. So this is what we call the income calendar spread. So this one is kind of more medium to, you can use this longer term. So with the calendars and calendar diagonals that we'll talk about, you can go out 1 or 2 or 3 weeks or months, you know, or even years. And so basically I call it really, it's a non-directional but directional. So I like to use it directionally. But what this does, it's a kind of a neutral option strategy to start with that's going to profit the actual construction of it. It profits from the theta decay and volatility decay, like a credit spread, but you've got a long duration part of it where the long part of the spread, you know, is where you can really make up the difference to make money. So this is going to profit primarily from going in the structure, the rate of premium decay and the implied volatility decay or crush between the near-term short option and your long-term duration option. So remember, the near-term option premiums decay faster than the long-term premiums. So it's a great strategy if you expect a stock or security to stay kind of more stagnant in a range, but then have a directional view. So if you think it's going to go up, but it could kind of stagnate for a while, then go up, or you think it's going to go down, stagnate, then go down, this is a great strategy. Plus, they're cheap, they're low risk, and can be very high reward. So I call them kind of a targeted range-bound trade. So when I do a calendar, I started out thinking, okay, we've got a certain area that we think it's going to go to, but it's not going to go there and just keep going. It's going to maybe stagnate for a while, then break out either up or down. So if you think and look at a market where you want to keep a long position or longer term position on for a stock or ETF, great for ETFs, but expecting it to potentially then break out either up or down, this is a great strategy. And this is typically one we'll start out with first. So you're actually getting paid while you wait. So the theory behind it, if you did this non-directionally period, is that let's say you're going to buy an option, either, you know, you can use weeklies or monthlies. So let's say you buy a $100 strike and you go out 60 days, you're long this option here. So you're long that. So it's going to have a smaller theta decay, right? Because you're out in the future. Now, then against it, though, you sell 30 days out, or you can do this weekly. You sell the 100 strike here against it. So it's the same strike, but different durations of the option series. So you're going out further on the long and going out in closer on the short, and that's going to be faster theta decay. All right, so that's how conceptually it works, but then we can use this directionally and kind of do adjustments to make it a directional trade. So here's how basically the simplicity of the math, how it works out. So let's say you go out and you're long the April 38 call, but then you're short against it the March 38. So you have this same short strike here at 38, long strike 38, but different durations on the option. So this one's closer in, this one's further out. Always done for a debit, so you know your cost, your risk. So you benefit from the time decay, passing of time, and also volatility, which goes to zero. Those two go to zero, okay, at expiration. So we're taking advantage of that. Defined risk, debit paid trade, takes advantage of that accelerated time decay from the options in the different time frames. So short duration here accelerates faster in decay. So think about it. So if you have an option contract with 4 weeks remaining, that's going to decay in value a lot faster than the long duration that maybe is 8 weeks out. So we can do this with you know, monthlies, with weeklies, a lot of different ways that we can take advantage of it. So in this example, just to kind of go through how it works, is you're long that April 38, it cost you $400. We sold against it the March 38 closer in, so it's going to decay faster. We received a credit of 100. So this was done for a debit cost of $300. So it's a debit trade. Now it trades sideways, okay, so that's going to erode the time of that 38. That's going to go down faster in theta decay than the 38 call here. So that's the concept of how it works. So towards that March expiration, that 38 call is going to be lower in value than the 38 call that's out in April. All right, so you're making the difference, but just from time decay. So if it goes nowhere, you're getting that theta decay kicking in. So if you look at it down the road, then let's say you're getting close to expiration on that March. Now the March call that you sold and received 100, now let's say it's only worth 50. So you can see that spread, and this one has stayed pretty much the same typically. So that spread now has gone from a value when you first put it on at 300, now it's 350. So it's a debit of 300, then now 400 minus 50 is now 350. So there's your profit. And it's kind of like a credit spread when you look at it just on the surface. So that's a 16 or 17% return. But the great thing with this strategy is that we can also then kind of tweak it to have it, break out or break down. We can stick with the long dated call or put. And if we think it's going to, let's say, break out, we can just hold that long call for the, move up, or a long put, and play it that way. So it also takes advantage of what we call skew. So here's just an example of positive skew. So if you look here, this is just Gilead, but I'm just showing you as an example. So you can see this 28 Feb, one day at expiration, it's got an implied volatility of 92, let's say, and the series behind it has an implied volatility of 87. So that's a positive, what we call a positive skew. So what you're doing to take advantage of this skew is you want to sell the close in with a higher implied volatility by the longer duration with the lower volatility, and you get that what we call the skew spread. So that's just one benefit that can really help as well. So let's take a look at how this works. I'll show you the same example, but in this case, doing this as a calendar. Okay, so let's pull up the chart so you can kind of relate what it's going to be looking like. And so we're going to set up a calendar here going to 160. So we're going to set a calendar targeting that 160 strike. That's where we think initially it's going to go, and then it could go higher, but we think initially it's going to go to 160, probably stay there, maybe hover, could come back off a little bit. So it could take time, but eventually we think it's going to break and go higher. So we can trade this with first starting out with a calendar, and then we can do this into a lot of different things. Calendar diagonal, we can adjust these to butterflies, debit spreads, all kinds of good stuff. So here's what it would look like. So we go out in this example. I typically like to go, you can go out as far out as you want, but typically I'll look at something like at least 20 days, 15 days out. So let's say we go out to and we buy the 16 April series, 20 days out. So we're going to buy a long dated here. So we're going to target 160. So I go out here and I can buy the 160 strike here, that call. So that's going to cost maybe $2, $200. And then I'm going to sell against it the 24 series closer in, and you sell the same strike. So I'm going to sell the 160 there, and you're going to bring in 30 cents or so for selling that 160. You're going to bring in about 65 for that. All right, so that's going to end up looking like this. Okay, so you want to go out, play that duration time frame. So we're going to buy the 6 April 160 strike. We're targeting 160, and then we're going to sell against it the 24 series, next week's expiration 160, bring in $70. So we just created this calendar for a total cost of, what is that cost there? I've got it written. So this cost here is let me see, 205 less your premium brought in 70. So this is $135 debit cost or risk. So this trade is a total risk of 135. So that's your max, potential risk on the trade. So we brought in, so it cost us 205 for the long dated, and then we sold against it. The 160 here brought in 70. Okay, so the total cost of the trade is your spread of 135. All right, so that's the max risk. Now, if it was to hit your 160 at expiration, this is what we're looking at, a risk reward to see if we like the trade. This right here, if we hit that expiration at next Friday of the 24th, it hits 160 and it goes out there, this would make you're about right here about 200, let's see, it's about $215. So right there, kind of like a butterfly. So you make $215, okay? So your potential profit, you've got a potential to make 215 on your risk of, 135, and your risk of 135, so that's like 160% return. All right, so, but if it doesn't go out there, you're still making pretty good money in this area here. Plus, if we wanted to, we don't have to get rid of the 160. We're out there 19, 20 days out. We can keep it and like a covered call, do it again over and over. So I'll show you the next kind of step. So let's say here next week, though, it goes out at 158 on the 24th. You can see here, I've already got that. You can see right here, we had it set up here at 150. So let's say, I'll put it here a minute ago at 158. So let's say next week on the Friday, the 24th, it's trading at 158. This would be $106 on that risk of, 135. So that's the beauty of it. And then we can do a lot of different things with it. We don't have to get rid of it. It's like a covered call. We can just stay with it and write another option against it. So for example, if we get to next week on the 24th and we sold that right here, where you see my pointer right here, the 160, we sold it, we brought in $70. So let's say next week it expires below that short strike of 160, where we're going to keep it $70, right? That amortizes down the cost of our long dated, which was 205. That's 6 April. That's going to then be reduced by that credit we received at 70. So now we've amortized this down, and now it's costing, that spread is $135. All right, so now we've got the 160 strike. It's no longer 205, it's down to 135. Well, we could turn around and just sell the next series out. We could sell the 31 March 160, and let's say it's going for, $35. So we bring in $35 credit. Now we've got the calendar, but we've got the spread now has gone from the original spread we had at 135. Now we've got the calendar on here at $100. Okay, so 135 less 35. Now we've got this calendar spread on for $100 debit cost. Okay, so we had the, we reduced it down to 135 from keeping that 70, and then we turn around. Let's say we sell the 160. Excuse me, it's going for 70 right here again. So we sell that again, and now we've got our spread cost. Let me back this up. So okay, so we kept the $70 there. That reduces the cost there to 135. And then we want to keep the calendar on. We still think it's going to, go to 160. We didn't get it the first week, but the next week we're still in it. So we sell that 160 strike here, and let's say we can get $70 against it again. All right, so we sell that. We bring in 70. And so now we've got the cost of the trade here is now $65 for that spread, right? So now we've got the calendar on for 65. And if it goes out here at 160, that's going to be, let me pull it up. You're going to be up $215. Let's see here, hold on. Yeah, let's see. Yeah, so if it goes out here, you're going to be up $218, okay? Wait, sorry, wrong. Let me adjust this. So now you amortize this down to 135, sold the 31 March against it, and now you've got that spread width is your trade is $65 debit cost. Now the week after that on the 31st, if it goes out at 160, now you're up $170 on your risk of 65. So you can just keep doing these things over and over, but then the next step, if you think that it's going to finally break out, Then we adjust it to what we call a counter diagonal, which we'll go through next. So the key though is look at your different risk reward and how it's increasing with each of these types of strategies. So here's some other examples here on the calendar. All right, so here's a couple that we've done, recently. This is one that we did on XRT, the retail ETF. We had set this up originally as a put calendar. On the 23rd, it was trading at 67.74. Now with this one, we adjusted to a long put condor, but I'm just going to show you the calendar side. So this trade we set up originally as a calendar, so we took profit on it as a calendar, but then we adjusted it later. But the initial trade was set up as a calendar. So we were long the 10 March 66 put, short the 24 Feb 66 put against it. And then on the 28th, we did an adjustment, took some profit, and then we adjusted this to a put condor. So I won't go through that yet, but we'll go through that in a little bit. So here's the trade. So it was trading right here, and we were targeting this area down here, right there at 66, right there. Okay, so it's trading at 64.74 right in here. Good support right here at 66. So we were targeting 66. We wanted to do a really cheap, low risk trade because this market's been so super volatile. So we hit down there to our target, and let's take a look at how it did. All right, so we set the trade up, and our cost on this trade was 99 cents or $99. Okay, so this was doing the long, the 10 March 66 put, short the 24 Feb 66. So you can see the spread there, and the cost of the trade was 99 cents or $99. Now on the 24th, this was set up on the 23rd. The next day, we took some profit. The next day, it was up $44, and that on the risk of 99, that's a 44% return. So that's just on the calendar. But then we can do other things. We can convert that to put debit spread, or a lot of different stuff. So it's just a great strategy to start with. But the thing that I like about it, calendars are super low risk when you start with it. You're getting a positive theta. So you can see here, this is a really positive theta trade. That's the theta on the spread right here, right there, $14 a day. And so it's got a lot of benefits. So there are a lot of little pieces to it, but and I'll talk about this a little bit more in the details of it, but I just kind of want to give you some illustrations of how it works. Now, this was another one we did on QQQ, and this was a put calendar that we set up for a downside move. With the market's volatility and everything and moving down, we set this one up. It was trading at $303. And then we adjusted this one as well to what we call a put calendar diagonal, but just kind of show you the potential impact that you can get and the profit that you can receive from these. So this was originally set up here long the 22 Feb 300 put, short against the 17 Feb 300. And then on the 17th, just a day later, we were taking profit and then adjusting. So I'm just trying to illustrate how these things can really make a lot of great money. So here's the QQQ, the chart. It was on the 16th. It was trading right, it was trading at 303.50 right in here. And then we were targeting down here to the 300 strike. So we did this calendar right here. We did the 300 calendar. Let me show you. So on the 16th, it was trading at 303.50. And then we took profit on the 17th, just a day later. This thing just really collapsed. So we bought the calendar. So we bought that 22 Feb 300, sold against the 17 Feb 300. This cost $120, $1.20. That's the max risk. Next day, it went from 303.50 and it collapsed down. Now it was trading at 301. So this was up, $96 per spread on our risk of 120, 80% return. But we could have kept the trade and adjusted it and did a lot of different things with it. So that's just another example there. Now the next kind of progression of the calendar is what we call the calendar diagonal. So this is a really great kind of the next step and a favorite as well. So this is a longer term directional option strategy, speculating on, direction, but also hedge by doing it as a counter diagonal, but it has a vertical spread component to the trade. So with the long option leg, which expires further out in time, and then you've got the short leg against it, it's going to be, closer in. So you've got the theta decay, faster duration, or faster accelerated theta decay versus that long option. But this one gives you a spread difference, which we call the diagonal. So this takes advantage of your short-term weakness or strength that you think will eventually in time revert and cycle either back up or down if your calls or puts. So you can then have time to let the trade kick in and work. So you're kind of getting paid while you wait. So with this one, you're taking advantage of, again, that accelerated theta decay from being short. The short duration is your short and you're long the back duration. So it's also going to get an impact from what we call positive implied volatility skew, which we can get from the two different series. So then you've got the additional vertical spread component, and that's what really adds the directional element for really big profit. And again, this is kind of like buying options at a discount. So if you look at this kind of the profile, think about it as like a call debit spread. So let's say you go long a call and short a call. Now, call debit spread is going to be in the same series. So let's say, you did this call debit spread in the 24 March series. That's next week, right? So you're long a call here, short a call there. So call debit spread. So this kind of looks like that. But the difference is you're going to be, instead of long the 24 March series, in this example, you're going to probably, let's say you go out and your long is the 6 April series. So further out in time. Okay, so you're long the 6 April series here, you're long that call. Let me back up, I've got that wrong here, hold on. So you're long the call here, but instead of the 24 March series, the long call is in the 6 April series, okay, so further out, so slower theta decay. So this is in the April 6 series, you're long that call 6 April. I could draw that, okay? But then against it, you've got, if you did a call debit spread, you're long the call here in the 24 series, short the call in the 24. Here, then you're short, let's say the call in the 24 March series. So what we're gonna get the benefit there is that faster theta decay. So plus we can keep the option if we want. So if you do a debit spread, you're done after the 24 March series expires next Friday, this trade is over. But if you do this as a counter diagonal, and you did this 6 April, or you could do this, you could do leaps. You could do it out a year. It's like a covered call. So you're still, instead of buying 100 shares or whatever it is, you're buying options, and you just amortize it down. So there's a lot less risk to this than a covered call, but also you get the benefit of a longer term trend up or down. So that's the kind of the takeaway, the beauty of it. So let's go through the example I showed you earlier on Apple, so you can see the progression here. So now we say you set up that calendar, but you think, okay, now we think it's finally going to break to the upside. So with the calendar, we had capped it at 160. But what we could do is we could take the next step. So let's say the first duration of this, we had that calendar set up here where we had the 6 April long at 160, we had paid 205. Then we were able to keep the 70 bucks right here. So we had now amortize it down to 135 on the long dated. So remember, this is out the 6 April series, okay? So now our base cost is 135, but now we think it's finally gonna make the break. So instead of selling at 160 against it, now we can sell up, we can widen that strike out. So we can sell let's say the 31 March, instead of selling the 160, we could sell the 165 against it, or we sell the 162 and make a wider spread. So now we've got the 160 strike out here in April. Okay, we're long that, but we're gonna sell closer in. Now we're gonna sell the 31 March strike against it, we're going to sell the one, let's say we sell the 165 against it. So it kind of looks like call debit spread, but we have the two different option series, so we can still hold the trade and work it for a further move to the upside. So if you look at this example, let me back up here, 135, and let's say now we want to sell that 31 March 165, and let's say it's going for $35. So now we've got this calendar, and we've got our cost of this trade now. The 165, 160, 165. We've got the 135 strike. Okay, right there, cost there, 135. Now we sold the 165 against it. We brought in 35. So now the cost of the spread is $100. Okay. Now, if it goes out next week, or let's say it goes out on the 6th of April, next week, the 31st, not next week, but the 31st, and if it goes out at 165 right here, this trade alone would be up. This is going to be up about, I'll show you in a second. Just trying to pull up the right thing here. This would be up 400 and let's see, yeah, $470 potential profit on your risk of 100. So that'd be like a 470% return. So I'll show you this. You know, it depends on where it is at the time, but the potential that you get from it. I can erase all this stuff. So let's say here on the 31st of March, this is the profile where it would be that teal. So on the 31st of March, if it was trading right there at that short strike of 165, this would be up over $470. Look at this little area right here. Hold on. You can see this box. Watch this box, and I'll hover over this, and you'll see what the profit would be. All right, so the teal line is what it is at expiration. So you can see if it was trading at 165, that would be like on the expiration date of the 31st of March. This would be up about $470, you know, on your risk of 100, the spread. So that's, you know, like a 470% return. But let's say it's not, you know, let's say it doesn't get all the way to 165. Let's say it's at 160. I'll put that in. This thing just, they have so much flex. I call them kind of flexibility trades because you have so many things you can do with it. So let's just say it's at 160 at expiration. I'll put this over to, let's say on the 30th. March 30th, not even expiration. Let's say it's trading at 160. We can see this is up $169. You have $169 on your risk of 100. Okay, so just a lot of great stuff you can do. And then, you know, if it doesn't get to 165, what are you going to do? You can keep your $35 premium. Your adjusted price was, you know, you had that 135. Now that's going to drop down to your adjusted price now is like, or advertising that's going to be then $100. And you could turn around and sell the next series, the 6th of April against it and keep going. So like sometimes this is referred to as a poor man's covered call. So just kind of wanted to kind of outline that. If you wanted to make it narrower, you could make, you've got the 135, you could sell the 162.5, and let's say that's going to be bring in a bigger premium. Let's say bring in 76. Now you've got your spread down to a cost of just $60. If you did it narrower, so you're long the 160, short of that 162, now your spread cost is down to 60, and you've got the potential, if it goes up at expiration, to make $320. So look at the graph here. So if it goes out right there at expiration, and you have that set up, you're up over $325 on your cost of 60. So just, you know, try to explain how these things can really add a big, huge benefit to your trading portfolio. So on the Apple chart, what are the lines at the 160, 162? and the 167.5, how are they calculated? Okay, so, these are, the option model is based on what we call, the input to the option model is going to be days to expiration, implied volatility, and then those are two basic components, and then where the price is. That goes into what we call the Black-Scholes model, and that spits out your mathematical outcome as far as your profit or what it's doing. And so with the model, then we can look at different days. So if we want to look at here, I can just put it on whatever day. So let's say we did this spread, and I want to see what the value of it would be on the 23rd. So let's say we have this spread now set up where we're long now, the adjusted price of that 160 April 6th option at 135, and we sold against it the 162.5, and we got 76. So at any point in time, we can see what this value will be based on time decay, based on that the value. So let's say it goes up to here, and it's just trading at 158. Okay, so let's say it's just trading at 158 on the 23rd. Well, you can see here, this is taken into the time decay component. Now this would be up to $118. So there's, it's kind of hard for me to explain here in 5 minutes how all this kind of inputs together. I'm just trying to, in this, presentation today, show you the difference between risk reward of these various types of strategies. Okay, so that's any questions on that? I mean, it's a lot to absorb, I know, but I want to show you the potential big benefits of the different strategies, the difference between them. So that's kind of a look there, kind of the next progression up. And here are a couple examples just to illustrate what we've done in the past. These things are really dynamic. Here's one that we had on the Russell 2000. What other questions here on the Apple candlestick chart? On the Apple, let's see, on Apple chart, what are the lines at 161? Oh, okay. Yeah, on this chart here, sure. So I put these lines in. This was the original example I showed you here. We had a credit spread, so 162, 167.5. That was the first example. This was a bear call credit spread. And then this was the bull put credit spread here, short the 147 put, long the 142. And then the other one was targeting 160 on a counter diagonal. So trying to illustrate the difference between the risk reward of these different strategies, kind of what I call progression of the risk reward. Now here are a couple examples of a couple that we've done on this one in the past, just to show you how huge these things can be. So this one was, we went long the 23 December 178 put, short against the 16 December. These can be really short duration when we use weekly options. And we set this one up for about 240 bucks. And this one ended up making some really big returns. So I'll just kind of flip through, show you the magnitude of what you can do with these types of trades. So here was the Russell. So this was a short trade. So it was trading right here about 178, 177 right there. We were looking for a downside move. So we set this up as a put counter diagonal. We made an adjustment, really reduced the cost of the trade. All right, so you're going to see the trade price go down pretty big because of the adjustment. So we were able to do this one where we had so much money made on the put side of it, we were able to adjust the trade down to actually credit. So we had this one has a credit of 65, and then it was trading down here at that 171. So it went from 177 to 171. We had made a couple adjustments. We had adjusted down our price here to a credit actually of $65. So we had no risk. And then this trade was trading at 171.73. So the spread was up to 250. So this was up over $300 on zero risk. So that's one that just to kind of illustrate what they can do. That was a put counter diagonal on Russell. Here's another put counter diagonal on QQQ. So again, we're looking for a downside move. So QQQ was trading at 274 right here. And then we took this off, then it collapsed down to 256, that area right here. And we had done this as a put calendar diagonal for an adjusted. We did an adjustment on this one as well. And we had the adjusted price down to just $50 right here. And so then it was up 784. So this was up $734 over 1,400% return. So just the flexibility of what you can do makes these two strategies just two of my favorites. So I really like the butterfly, long condor, not the iron condor, long condor, calendar diagonals. Those are they're just exceptional. So can synthetic options use calendars? Well, you don't want to. These are just using just straight. Either you go long further out and short against it. It's not kind of a synthetic long short type trade setup. So today I just kind of wanted to get everybody better kind of set up, educated on the different great trading investing advantages that you get from these different strategies to kind of give you a better feel of how to incorporate these kind of income strategies into your trading portfolio. But the focus I wanted to kind of point out were the two big, huge benefits of the calendar diagonal. So there's a lot more to it, obviously, than what I could explain today in this presentation. So next Saturday, the 25th, I'm going to be doing a live option trading workshop that's going to be solely on the income calendar diagonal. So these are two of my very favorites, and they're ones that we just do a lot at Paracycle Trading. So if you're already a member to the Paracycle Trading, you'll see these. We do these a lot, and they've been very successful for us. So I'll be doing a full workshop on them next week, the 25th, and so we'll have that starts at 11 a.m. and then goes to 2 or 3 typically, how long it takes to get through it, and then we'll finish up not on Tuesday. That should be Monday, the 27th, from 4 to 6. But this is a great package, and again, these are just tremendous strategies that if you really want to get a leg up, great timing edge, these and butterfly, well, there's just a lot of different strategies, but I really like these quite a bit because of the flexibility they offer. So here's the link, and let me go through what you're going to get and then take questions, and be happy to take any questions that you might have. So with this one, we're going to have $197, 6 bonuses that you get with it. So basically, here's all the good stuff that you're going to get with it. Now, when I do a course, I like to give you the things that are going to help you, with these types of trade setups. So as a bonus, you're going to get my cycle reversal indicator. Maybe you already have it, but this is a really key tool to use for these types of trades. So if you look at my website, this is the indicator, the reversal indicator is 197. You're going to also get my extreme range band indicator. That's also 197. So these are bonuses. You're going to get my Fibonacci target mapping course. So this is how we set up our price targets based on Fibonacci and some other things that go within the course. So on the website, this is $397. You're going to get a 30-day trial membership to the trading club if you don't already have it, if you're not a member. So that's a $97 a month. If you stay on, hopefully you will. And then we'll do a Q&A, follow-up Q&A, and then you're going to get option trading tutorial on the Greeks. So really good value of over $2,400 here for $197. So that's course package 1. Now, if you want it with the alert service, then that's also a package that I've got available. So here's the link for that one. Let me put that in one more time for you. So that's the link there. Now, if you want it with course package 2, this would be with the alert service. Let me get that one. This link is paracycletrading.com/alert CAL calendar. And basically with this one, you get everything in course package 1 of 197, all the indicators, the bonuses, but you'll get my alert service for 4 months plus access to the trading club for 4 months and everything in that course package 1. So with this one, you'll get the actual alerts that I send out on calendar diagonals or calendar and diagonals. Any butterfly alerts or condors that I send out, you would get those. Any kind of breakout trades, which are debit spreads or credit spreads, you'll get those. And any earnings trades that we're doing or I send out, you get those. So basically 4 different kind of alerts that you would get. But we tend to do the most trade setups we do are going to be between the calendar diagonals, and the butterflies. So these are just kind of back and forth, the ones that we really do a lot of. And then when we get in earnings season, we'll do selective earnings trades there. And these are usually calendars as well, what we call a double calendar. So again, the calendars are just so flexible to use. Now with the Elite open to close service, you get 4 monthly alerts, 4 months of trading club, everything in course package 1. So total of $597 with the, if you want a 2-pay option, that's available for you too. So we typically, anywhere from 10, maybe 15 stocks a month, and do a lot of ETFs. The ETFs are really great for calendar diagonals because they're very cheap and they're not as volatile. They're smoother at movement as far as the ETFs. So really great. We do a lot of ETFs. So you're going to get either breakout trades, calendars, butterflies, earning trades, all that. When I send out alert, you'll get a trading guide for each. What option series to use, etc. I do a video review of these trades. If we do a calendar, whatever we do during the day, I'll do a video review of it after the close, kind of go through why I did it, what it's looking like. These are all listed in archives, so you can go back and look at them. You'll get then access for the next 4 months to my weekly Q&As, typically every Tuesday, which are live and recorded. My daily video newsletter every day after the close, I put that out, so we have that for the next 4 months. Access the virtual trading room, so come in and ask any questions on any trades that you have on or help that you need with a trade that you're in or anything that we're setting up, plus 60% discounts on all courses and software. So you can stop and start this at any time. So if you do the course package 1, your 30-day trial, you can start when, you don't have to start it right away. And if you do this package, let's say you go on vacation, you can start, you can stop it for, a week, 2 weeks, however long you want, and then start it back. So you can kind of use that time as you go. Now here's a kind of a summary of these, just all the alerts together. So since I started the services, I started back in May of 2018 with the breakout trades first. Then we've added calendars and butterflies, but through Friday, we've had 587 trades closed out. We've had 442 winners, 33 break even, 112 losers, 81% winning rate. These are unaudited, but this is a summary of the trades that have been sent out. And then the biggest and most of them that we've been doing lately have been calendars. So here's the calendar diagonal service part of it. And through yesterday, we've had 196 trades closed out, 152 winners, 8 break-evens, 36 losers, 82% win rate, unaudited. But they're a real good selection because the flexibility that they give us and gives us a little bit more time to work the trade. So if you're doing straight, credit spreads, you have that set duration, but with the calendar diagonals, you can have a little bit more time to work the trade. So it really gives you that extra benefit. So that's the 2 different packages. And then here's a little bit of feedback. This was from Pam, said just sending a quick note of thanks that you could maybe pass along to Larry for all the fabulous teaching through the years. I truly enjoy learning from him and the other traders in the trade room. I don't think there's a better trader in the world when it comes to option spreads and the other ways to do trades than what Larry Gaines does. So that was just kind of nice feedback there. Now here are the enrollment bonuses, just a quick review. These are important indicators for any of these trades, but especially these calendar diagonals. So you're going to get this as a bonus, my cycle reversal indicator. So we can really pick when markets are starting to turn up, turn down, and then we can set calendar diagonals based on these cycle changes and reversals. So this is a kind of a reversal signal that has an upper study that gives you the reversal arrow up or down, plus an overbought, oversold condition to the market. So really one that we utilize and do a lot with. So here's what it looks like. And if I just pull this up with my other indicators, but it's a really fantastic indicator that we use for every trade setup. So you can see it's down, basically down here. So you can see this was actually on Apple. There was a cycle reversal right there. See right that crossover. This is a reversal indicator. This also illustrates overbought, oversold. And here was the reversal. This was back on March the 3rd. Boom, up she goes. Here was a reversal to the downside, reversal to the downside, reversal to the upside. Okay, so that's what that indicator, you'll get that. Here it is without my other indicators, but it's just such a great tool for, picking these cycles. Here was a really good one here. So you can see back here, see that reversal arrow? That's based on this indicator down below. So this was a daily reversal up. You can see how the market came down, crossed over, reversed up, off she goes. So you'll get that as a bonus for this course package. Okay, and then the other indicator you'll get is what we call my extreme range band indicator. And this one is what is used when we start seeing markets get too stretched, kind of to the upside or downside. It's kind of looking for kind of that mean reversion. It's based on average true range. You're going to get this indicator as well. And this is a quick kind of look at what that looks like. So you can see here's these range bands are called average true range. And so when a market gets way too stretched, either up or down, this is what we use. So for example, if you're looking at something like, let's just say, for example, Google yesterday just had this massive run up. And you can see now it's up at the top. See here, it broke the 3 ATR and then it topped out. Look at that. Here's to the downside. This was to 2 ATR upside move. Anyway, this is how you can judge if something's getting overbought, oversold, and too stretched from its moving average. So it's what I call my extreme range band indicator. Now, these are available for Thinkorswim, TradeStation, TradingView, and we've got the extreme range bands for Thinkorswim, TradingStation, eSignal, Ninja Trader. So you can have any of these platforms. If you've got one or all, you can have them at no additional cost. So this is what that looks like. Again, I showed you that this QQQ cycle reversal 3 ATR. And then as the other really great helpful tool that we use for any trade setups is what I call price target mapping. And this is based on how we set our profit targets, either up or down, and defense lines. And so use this kind of methodology, which is a combination using Fibonacci, trend lines, support resistance levels, expected move, standard deviation forecasting, and price option activity. So it just goes through how that is used to set price targets. So it's a 3-hour course with videos and the manual of it. So you'll get that. You'll get my trading club for a 30-day trial. You can start it whenever you want. So you don't have to start it right away. So this gives you access to my virtual trading room each and every day from 9:30 to 10:30, every day during the week. Daily market video, newsletter every day after the close, weekly Q&A typically every Tuesday. My Traders Educational Vault is also access for the members, and discounts of 60% off anything on my my packages for Power Cycle Trading. So if you go to powercycletrading.com and you want to buy anything from my site, any of my trading software, courses, or whatever, anything here is 60% off to you as a member. So that's a really nice benefit. And then bonus 5, we'll do a live follow-up Q&A, typically the day after, so it's fresh in your mind. Then you get that 30-day trial membership. And the last bonus is another kind of option tutorial. So this is a 60-page option guide with videos on the Greeks, how delta, gamma, theta works, option pricing, more standard deviation, trade probability. So basically, everything to help you make a successful from this course, I wanted to include into this package for you. And then if you want the trading alert service, that's $597, and you'll get this for 4 months. 4 months to the trading club. You'll get selective breakout trades, credit spreads, lots of calendar diagonals, and lots of butterflies and condors, and then earnings trades. So those are the 4 different alerts that are sent out. So you'll constantly have some decent trades, really good trade selections that I send out. And I'm very, very selective on the trades that I send. I've spent a lot of time trying to make sure they're low risk, and good returns on that risk for you. So that's kind of everything you'll get. Little feedback. This was from Waleed, one of my members. He lives in Kuwait. Says, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not that great. But one thing I'd like people here to know is that when I receive an alert from Larry, I do it blindly as time has shown me that this man is dead accurate in his recommendations. So thank you, Wally. That's why the reliability and the winning rates have been high, because I'm very selective on the trades. And this is one from Dan. He says, you're very diligent and totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took with you when I was just learning how to trade options. Please feel free to share this with your participants. So appreciate all that. And so with the alert service, you get suggested option trade. I'll give you the entry levels, profit targets, what those are based on, the Fibonacci levels, what option series to use, stop loss levels, and the trades are listed so you can go back and look at them. I do a trade setup video review that night after the trade is done. You'll get the daily video newsletter every day after the close, access the weekly Q&A typically every Tuesday, live and recorded, and access the virtual trading room during the week, 9:30 to 10:30, and discounts of 60 off in the Traders Vault. So a lot of great stuff. And again, the summary there, 81% winning rate over all 4 services over that period of time. And here's going through some other trades that we've done in the calendars. So again, really good trade reliability, 82%. And here are a few that we've done recently. This was on UNG, the natural gas. And so we set this one up just on UNG, and this was a really cheap trade. This was trading at 868, and then we did an adjustment, and then you can see where this went out. So I'll just kind of go through these. I won't spend too much time, just want to give you an idea what they look like. So this was a calendar that we did on UNG. So this was long the 9 March, short the 3 March call. This was the let's see where this was the $9 call calendar. Let's see here. Long the 9 call, short the 3 March 9 call. Yeah. So just wanted to show you how real cheap these can be. So when we're in this kind of crazy volatility, I've been trying to find really kind of low risk, cheap trades, and a lot of them we've been going to have been calendar and calendar diagonals because they're cheap. Okay, so this is one that we did on UNG. So it's breaking to the upside here. So we set this up as a calendar, and you see here see how cheap this was. This was done. We did one adjustment, I believe, and this was set up. We had this reduced down to a cost of 38 cents, $38. And ended up 38, so 100% return, but very cheap trade. So trying to get things that are cheap and low risk for you in this kind of environment. Here's another one that we just did. This was on the retail sector XRT. So we did, this was a calendar we did, and this one was back on the 23rd, and then did an adjustment the 28th and did profit on the 8th. So this was a calendar that we did here, was being long the 10 March 66, put short the 24 66. And I showed you this one earlier, but this is one we adjusted to a put condor, and I'll show you that in a minute how we ended up with this one. So we had this initial trade here as a calendar, and moved down to 66, took profit there on the calendar. I showed you this earlier. So this was up, $44 on that risk of 99. And then we did adjustment. I'll show you this one in a second. Here was another one. There's QQQ put calendar that we did on the 16th. And this one we were looking for a downside move. And so shorted this and targeting 300. And so this was done for 120 bucks and then went out. We were targeting 300. It went out at 301. So this was up $95 or 96 on that risk of 120. That was a put calendar. Here was one that I think I showed you this one earlier. This was the Russell put calendar diagonal. This one was really one that we really nailed it because we did a couple adjustments and then ended up taking it off here. So this one was one that we did that adjustment and reduced it down to credit actually of 65 and went out up, $316. So on zero risk. There was one we did on GLD, the gold ETF. This was a put calendar diagonal or a call calendar diagonal, long call calendar diagonal that we set up when it was trading at 169 and then did a couple adjustments, ended up taking it off at about 172 right here. So here's where this was set up at $1.63 and then went up. We had $136 profit on that risk of 163. And just one more here was on QQQ, another one. This was a put calendar diagonal, and this one went short at 267 and dropped down, really crushed it to the downside. And we had this set up as a put calendar diagonal. So we'd set this up at 478, what was blasted up to 782. So up $304 on that risk of 478. Here are a couple other illustrations of a put butterflies and condors that we've done. So here's the summary there. We've had through the 17th, 121 trades, 90 winners, 6 break even, 25 losers, 79% win rate. These are really low risk trades too. Typically, risking maybe $50 to $150 risk in butterflies, get 2 to 3, 4, 5 times to 1 risk reward. So really good risk reward ratios on these. So here are a couple examples. If I can get rid of this drawing pen. Here's the XRT. So this is one we started out with a put calendar and then adjusted this to a long put condor, what I call free trade. So we ended up adjusting it to zero risk. Okay, so I won't go through the details, but here's what we started out here. Took some profit when it was right at that 66 of the calendar, and then adjusted this into what we call a long put condor. So ended up with this adjustment here where we were, then we started out, ended up long that 66 put that we were long the 10 March series, then sold against it by the adjustment, the 65 put, brought in 70, offset the cost of our adjusted $70 there, and then sold the bear bull put credit spread here, brought in 17 bucks. So adjusted this to zero risk, or actually a $17 credit, okay, and potential to make max profit of 117. And so that was the adjustment that we did, and it went out right here, if I can get it lined up for you. So went out the additional profit from this, the adjustment went out right there. So we had this on as a credit and went out here at $52, $68 or 69 spread profit on zero risk. So just kind of a little bit of flavor to all the things that try to do that are always trying to adjust with low risk. Here's another one we did with QQQ using a put butterfly. So here was the setup on the entry was short there, targeting down here to that 290. So this was a long put butterfly. And so we set this up for the risk $90. Ended up making 171, 190% returns. So these are all alert trades. So that's kind of pretty much everything.